Welcome to Marmor webinar series. My name is Arnav Singh and I am a research analyst at Marmor Mena Intelligence. Marmor is a majority-owned subsidiary of Kuwait Financial Center, Marcas. Established in 2010, Marmor has developed full-fledged research capabilities covering multiple areas such as infrastructure research, economic research, capital market studies, policy analysis, etc. Marmor serves the interdisciplinary knowledge needs of its clients and stakeholders. In today's session, we will be covering the GCC capital market reforms. We will be talking about in detail the capital market reforms in Kuwait and Saudi Arabia, followed by the implications for the investors. Questions, if any, could be asked at any time during the course of the webinar, and it shall be addressed at the end of the presentation. Recording will be sent in a day or two, and the same will be uploaded in the Marmor website and YouTube channel. Questions can also be mailed to the email ID, which will be displayed at the end of the session. So I will start the presentation with the overview of the capital market. So as we can see, the market capitalization of Kuwait and Saudi Arabia is more than the combined market capitalization of rest of the GCC countries. The MSCI index classification currently in the frontier market includes Kuwait, Oman, and Bahrain, while UAE and Qatar are the two countries that are currently in the emerging market index, while Saudi Arabia is still a standalone market and it is not included in this index classification. The Kuwait is likely to be upgraded to emerging market index in 2018 with a weightage of 0.5%. And also Saudi Arabia is also likely to be included in emerging markets by the end of 2019 and possibly with a weightage of 2.3%. Talking about the IPO activities in the GCC countries, as we can see, there was a lot of IPOs going on in GCC just prior to the financial crisis. However, since the financial crisis, there has been a sharp dip in the IPOs in the GCC countries, which are starting to rise little in the last few years. But since there was a oil crisis and geopolitical issues in the region, the IPOs has been a little less. However, we can see a revival since 2017 and in upcoming years with the IPO of Saudi Aramco. Talking about the country-wise IPO of GCC countries, from 2015 to 2017, Saudi Arabia and UAE combined account for almost 75% of the IPO issues in GCC countries. Yeah, this slide shows a snapshot of the capital market view in 2017. The combined market capitalization of all the GCC countries is close to $900 billion, and it represents almost 62% of the market capitalization. Now, talking about the debt issuance, the sovereign and municipal authority issuances reached a record high in 2017, surpassing USD 60 billion, out of which 37.8 was issued within the GCC region. The same figure for the 2016 was close to 42 billion. As you can see, the asset under management for mutual funds is relatively very low, as most of the investors in the GCC region, including high net worth individual, invest their amount in foreign countries. Talking about the performance of the indices in the GCC countries, we can see that the only UAE has outperformed all the other countries in the last 5 to 6 years. If we assume an inflation rate of close to 4%, we can see that majority of the indices except UAE has failed to give the returns equivalent to the inflation rate. Now, talking about the turnover ratio, we can see that the Saudi Arabia has a fairly high turnover ratio. However, the other countries have low turnover ratio since there is a lack of liquidity in those countries. However, in the past few years, the turnover ratio for Saudi Arabia is also on a decline since the collapse of oil prices and geopolitical events in the region. This figure shows the index performance of Qatar and Dubai market. Since the announcement of the MSCI in emerging market inclusion, both the stocks has outperformed and given substantial returns close to 50% and over 100% for Dubai. UAE was promoted to FTSE emerging market in 2010, but continued to remain as a frontier market with MSCI till 2013 due to settlement issues and restrictions on foreign ownership. However, Qatar was included in MSCI emerging market in 2014, but it was only promoted to FTSE index in 2016. Now we will move on to the capital market reforms that are relevant to Kuwait. So as we can see, before 2010, there was a volatility in the global market, which was affecting the Kuwait market as well. There was also privatization in force. However, after the financial crisis in 2008, in order to protect Kuwait's capital market against any future downturns, Capital Market Authority was established to improve the market in line with international standards. There were also a series of new rules that were aimed to boost transparency and liquidity, improving risk management and corporate governance. As you can see, there was also introduction of market making regulations by Capital Market Authority. Also, there was the privatization of Kuwait capital market in 2016, and we can possibly see an IPO of Kuwait Stock Exchange in the upcoming years. Since Warsaw Kuwait took over operational management of the Kuwait Stock Exchange in 2016, it has rolled out a new company information portal for listed companies to directly upload financial disclosures and statements, which the investors can directly have access to. It was also followed by the launch of an interim post-trade model, which has reformed price limits and tick size movements, and also unified the settlement cycle to 2E+3 and established a randomized closing auction to minimize the price manipulation. MSCI reviews the market accessibility of various countries based on the three primary factors. It is the openness to foreign ownership, ease of capital flows, efficiency of the operational framework. In the past few years, Kuwait has performed well on these parameters and its rating has been constantly improving, and it is likely to be upgraded to the emerging market. The authorities are working to develop the secondary phase of interim post-trade model in Kuwait. Following the rollout, the Borsa plans to extend into derivatives products and exchange traded funds for local and foreign investors, and also planning to introduce short selling, which will further improve the rating for market entry and market organization. It also need to work on the foreign ownership limit so that its overall accessibility is improved. Now, moving on to the capital market reforms in Saudi Arabia. The Capital Market Authority in reform in Saudi Arabia was started with the requirement for the qualified foreign investors of $5 billion, which is now reduced to only 500 million in January 2018. It has also raised the amount that an investor can invest from 5% to 10% in order to enable the foreign participation. They have also seen the introduction of T2 settlement. Also, there was the introduction of NOMU by Capital Market Authority, which has enabled the borrowing and lending of securities and also encouraged small and medium-sized enterprises to go public due to lesser listing requirements. Also, we could see the adoption of IFRS rules in the market. Talking about the MSCI Market Accessibility Review for Saudi Arabia, in the 2017 review, we can see an improvement in the ratings, particularly in information flow and clearing and settlement and custody. The Saudi Arabia has worked tremendously through reforms to improve its market accessibility. However, still 49% of the limit is there for foreign ownership, while for a few companies it is fully closed for foreign investors. The implementation of IFRS led to improvement of the market over organization rating. However, there is still scope for improvement as some information is still provided in Arabic. Moving on to the implications for foreign investors. As we can see, the uh, inclusion in secondary emerging market has will increase the capital flow in Kuwait and Saudi Arabia, particularly because these are passive investors amount to a great chunk of the asset under management, and they are likely to increase the exposure to these countries. The Saudi Arabia, which is currently a standalone market, can expect a capital flow of 36.8 billion, as its weightage will be around 2.3% out of the asset benchmark. And we can also see the uh, IPO of Saudi Aramco, which could raise additional flow of close to USD 200 billion. The transition of Kuwait and Saudi Arabia into the mainstream emerging markets will boost investors' confidence, thus attracting more investments in the region. It is thus likely to increase the liquidity in the market and attract more foreign and domestic institutional investments. We can expect an improvement in the level of performance in Kuwait and Saudi Arabia, as already showcased by the Qatar and UAE markets post their inclusion in the emerging markets. We can also expect that there will be a large inflow of capital, and also these countries will be much more able to compete with their regional peers as well as all their competitors in the emerging market. With this, I will conclude the presentation. So we have a question here. If we have the list of stocks which will be most likely to be included in MSCI upgrade in Saudi Arabia, we can expect all the blue chips companies in the Saudi Arabia to be included in the list of stocks. Also, we can expect the inclusion of Saudi Aramco post its IPO. We have another question. FTSE hasn't considered Saudi Arabia for upgradation this year. Does this mean Saudi Arabia has a long way to go before MSCI considers it favorably for inclusion in its index? I think both the FTSE and MSCI have reviewed the Saudi Arabia, and then they have commented positively on its performance and reforms that it has been undertaking for its capital markets. So we can stay positive and probably expect the case Saudi Arabia's inclusion in 2019 or maybe by 20. We have another question. With a global tightening cycle in place, with major central banks now removing QE and in the US raising rates, do you see the pool of passive funds investing into emerging market increasing or decreasing? I expect that the funds that are going to be in the emerging markets is going to steadily rise over the few years, and especially if post the inclusion of new countries, their exposure will also increase. So overall, the emerging markets are likely to have more inflow of funds. Thank you for your interest. Recordings will be sent in a day or two, and the same will be uploaded in the Marmor website and YouTube channel. Questions can be mailed to the email ID, which are displayed at the end of the session, which is the inquiry@e-marmor.com.